Welcome back to the second part of this lecture presentation. We will focus on Chapter 11 of your textbook, and this is where we'll discuss overhead variances and flexible budgeting. The learning objectives that we will be focusing on in this part of the lecture are learning objectives 5, 6, and 7. As expected, learning objective 5 is where we will learn how to calculate the variable overhead as well as fixed overhead variances. We will continue with the illustrative example that we have been using in the first part of this lecture. This time we are focusing on the overheads, the variable overhead and the fixed overhead. Variable overhead variances act similarly to the direct labor variances. Most of the time, variable overheads will be based on direct labor hours. And if that's the case, then the variable overhead as well as fixed overhead will be having a rate that is based on the labor hours. And that is actually the case in this corn chips manufacturer. You would notice that total labor hours per bag of chips is 0.0078. We're adding the inspector as well as the machine operator's hours. So you can see here that the variable overhead has a standard rate of 385 and standard hours of 0.0078. The same is true with fixed overhead. 0.0078 is the standard hours and the standard price is $32.05. But focusing on the variable overhead variances, we need to be provided with additional information as to the actual variable overhead costs. So we are given here the figure for the actual variable overhead cost, and that's 1,600. They also told us that the actual hours worked is 400. So we can see from here straight away, if you divide 1,600 by 400, you will get $4 per hour. So that is the actual rate. Now remember that the number of bags actually produced for this period has been 48,500 bags. We can calculate that the hours allowed for the production should have been 0.0078, that's the standard hours, multiplied by the actual units produced, 48,500 bags. So that would give us standard hours allowed, 378.3 hours. With that, we can already calculate the applied variable overhead. So that should be the standard hours allowed of 378.3 multiplied by the standard rate for variable overhead of $3.85. So that should be 1,456. Since we will also be calculating fixed overhead, we are told here that the budgeted fixed overhead is 749,970, and that is based on 3 million bags of chips. So they were expecting that their volume of production at that budgeted fixed overhead would be for 3 million bags of chips. And so how many direct labor hours will be needed to produce 3 million bags of chips? Well, remember that the standard hours is 0.0078. So 0.0078 times 3 million will give us 23,400 hours. And so that is the practical activity at which the company calculated the standard fixed overhead rate. So if you divide 749,970 by 23,400, that is how they got the standard fixed overhead rate of $32.05. Now, they also provide us the actual results. So actual production, they said for the entire year, they produced 2,750,000 bags of chips. the actual fixed overhead cost is 749,000, and the standard hours allowed for actual production should have been that 0.0078 multiplied by the actual production in units of 2,750,000. So standard hours allowed should have been 21,450. We will start with the columnar approach to calculating variable overhead variances. And you will notice that this is very similar to your material as well as labor variances. So we will start with the actual hours at actual variable overhead rate. Now this is already given to us. It's that $1,600, and we have actually calculated that the actual variable overhead rate is simply 1,600 divided by 400, right? So that's $4 times 400 hours. Next, we'll compare it with the middle column here, and that is the actual hours times the standard variable overhead rate. Now, we know that $3.85 is the standard variable overhead rate, and we are also told that the actual hours was 400 hours. So we'll just multiply that, 385 times 400, and that is $1,540. So from there we can calculate the variable overhead spending variance. And this is very similar to your rate and price variance. So variable overhead spending variance is 1,600 minus 1,540, $60. And that is unfavorable because the actual cost, 1,600, is greater than the actual hours at standard rate. Next, let's move to the efficiency variance. So we are comparing the middle column with this column, and that is the standard hours at the standard variable overhead rate. So we have already calculated that the standard hours for 48,500 bags of corn chips at 0.0078 hours will be 378.3. And so we'll multiply that by the standard rate, $3.85, and we'll get 1,456. So when we get the difference between 1,540 and 1,456, we get $84 efficiency variance. And that is again unfavorable because the actual hours at standard rate is greater than the standard hours at standard rate. Now, when we total up the spending and the efficiency variance, because both are unfavorable, so we'll just add them, and that will give us a total variance of $144 unfavorable. Now, we can also calculate the overhead variances using the formula method. And you must have guessed it, the variable overhead spending variance, also known as variable overhead rate variance, has similar formula with the material price or the labor rate variance. It's actual rate minus the standard rate multiplied by the actual hours. So to calculate that, we have already determined that the actual rate was $4, the standard rate was $3.85, and the actual hours was 400 hours. And so that would give us $60 unfavorable spending variance. Now, the variable overhead efficiency variance is given by the formula actual hours minus standard hours multiplied by the standard rate. And so we have already been given the actual hours at 400. We've also calculated the standard hours, 378.3 hours, and the standard rate was given at $3.85. So we have a variable overhead efficiency variance of $84, and that too is unfavorable. All right, now we are ready to move on to fixed overhead variances. Again, we'll start with the columnar or the tabular method. So what we are comparing here are the actual fixed overhead, the budgeted fixed overhead, and if you recall, there is a third overhead, and that is the applied fixed overhead. So the actual fixed overhead is already given $749,000. Did they tell us what is the budgeted fixed overhead? Yes, they did. It is $749,970. So the difference between actual and budgeted fixed overhead is what we refer to as the fixed overhead spending variance. And it looks like our budgeted fixed overhead here is $970 more than the actual fixed overhead. So we can say that we have saved $970 in fixed overhead, and that's why the spending variance for fixed overhead is favorable. Now we're ready to move on to the second fixed overhead variance, and that is known as the volume variance. Now this volume variance is kind of different from all the other variable cost variances that we have learned to calculate. Here we are looking at the budgeted fixed overhead and comparing it with the applied fixed overhead. You would notice that in terms of fixed overhead, we are looking at the entire period, not just the 48,500 bags output that we have been using in the variable cost variance calculation. Here, we are focusing on the practical activity versus the actual activity. And so we are told here that whilst we were expecting to produce 3 million bags of corn chips for the entire year, we only produced 2,750,000 bags for the current period. And so in the volume variance, we will determine this by looking at the budgeted volume versus the actual volume. And from there, we can already see that we should have an unfavorable volume variance, because as long as our actual volume is less than the budgeted volume, our volume variance will be unfavorable. So that is the case here. Our budgeted volume is 3 million, our actual volume is 2,750,000 bags of corn chips only. So, but how do we calculate it? We know now that it is unfavorable. That is for the volume variance for fixed overhead. But how do we calculate the cost? Well, we need to compare the budgeted fixed overhead and the applied fixed overhead. So we already know what is the budgeted fixed overhead, they told us. But what is the applied fixed overhead? Well, this is how we calculate it. The standard fixed overhead rate, $32.05 from the standard cost sheet. It's based on 749,970 divided by 23,400 direct labor hours. That's our practical capacity. So that's how we got that $32.05. Then we'll multiply that standard fixed overhead rate, because that's the predetermined fixed overhead application rate. Remember, the POR, predetermined overhead rate, is $32.05. Then we multiply that by the standard hours for the actual volume. Well, we've already calculated that. That's the standard hours allowed for actual production. Remember, our actual production is only 2,750,000, even though we have budgeted and we have capacity for 3 million bags of corn chips. But we only produced 2,750,000. The standard hours allowed is 0.0078. So we'll multiply that. And that's how we got 21,450. So now, when we multiply 21,450 labor hours times the standard fixed overhead rate of $32.05, we get the applied fixed overhead of $687,473 rounded. All right, so now when we compare the applied fixed overhead by the budgeted fixed overhead, we get $62,497. And because our actual volume is less than the budgeted volume, remember the budgeted volume is 3 million, actual volume is 2,750,000 only. So this volume variance is unfavorable. So after all that, we thought we've done well. Our spending variance was $970 favorable, but actually when you get the difference between the volume variance that is unfavorable, 62,497, and the spending variance that is favorable, $970. So our overall fixed overhead variance here is still unfavorable, $61,527. And so the total fixed overhead variance is actually calculated by getting the difference between the actual fixed overhead of $749,000 and the applied fixed overhead of $687,473. So that gives us the unfavorable variance of 61,527. By far, this is the biggest variance of all, and so it is most certainly worth investigating. All right. Let's now move on to the formula method. So the formula for fixed overhead spending variance is simply actual fixed overhead minus budgeted fixed overhead, and that gives us the same figure, $970 favorable. For the volume variance, it's simply the budgeted fixed overhead minus the applied fixed overhead, and that gives us $62,497 unfavorable. Well, that is it for the calculation of variances. Let us now move to the sixth learning objective, and this is where we will discuss some behavioral effects of standard costing, and we will also discuss here the interaction among variances because it's important to understand this. Let's talk about the behavioral impact of standard costing first. Let's suppose that it is within your power to choose which material, whether it is top quality or medium quality or low quality, that you buy. And you are responsible for the cost of the product. Maybe you are the production manager, for example. All right. So you might ask the question, should I buy cheaper materials? Because if the direct materials expense are lower than what is budgeted, then perhaps I will look good and perhaps my bonus is tied up with the direct material costs. All right. The issue though is that if you buy low quality materials, it will affect the quality of our product, and the customers might actually change from buying our product to going to the competitor as a result. So that will not look good for the company, and the performance of the entire company will be affected, whilst only one person might be enjoying the bonus. So you can see here the impact on the behavior of the employee or the manager if their bonus is tied up with the costs that they incur. All right. So in my example, I was thinking of the production manager, but who is actually in control of the variance? Is it the purchasing manager or is it the production supervisor? When we're talking about price variances, whose job is it to buy the materials? Well, it is the purchasing manager who will be buying the materials, right? Who is in charge of using it in the production and overseeing the people, the workers, whether they are using more or using less, or whether they have a lot of wastage of materials? It's the production supervisor. Who is in charge really of the labor variances? Well, we can say that again, the production supervisor would be in charge of the efficiency of the workers, the laborers. But what about the rate variance for direct labor? Could it be that the human resource manager might be the one deciding how much do they pay the workers and what skill level pertains to the rate that are being paid? You could probably say that the production supervisor will still have a say as to the skill level of the workers being employed, but at the same time, the human resource manager might determine whether they should pay more or less depending on the experience of the workers. And who is in charge of the variable overhead variances as well as the fixed overhead variances? We might say that, well, if the basis of allocating the variable and fixed overheads are based on direct labor hours, then it's likely the production supervisor who will be in charge of that, isn't it? Now, it's also important to note that apart from determining who is in control of the respective variances, that these variances are actually interrelated. So here is an example of how variances interact with each other. A company makes a conscious decision to use lower grade raw material to save money. However, if later on they realize that the scrap and direct labor costs increase slightly as a result, the question is, should they continue doing it? Well, it will cause potentially an unfavorable direct labor efficiency variance and an unfavorable direct material quantity variance because of the wastage. All right? If the amount of the favorable material price variance exceeds the unfavorable efficiency variance for labor and the unfavorable material usage variance, then perhaps they have made the wise decision to go ahead and buy lower grade material. But if it is the other way around, the unfavorable labor efficiency variance plus the unfavorable material usage or quantity variance is higher than the savings they have in their favorable material price variance, then maybe it is not worth doing it. They should probably go back to buying the good quality raw material in their production. All right, well, that's it for Learning Objective 6. We're now ready to go to our final learning objective, and this is where we will learn to prepare a flexible budget and will explain its significance to cost control. So what are flexible budgets? Well, flexible budgets are detailed budgets that are prepared for a range of levels of activities. And we normally compare the flexible budget to the static budget. So you might say, what is a static budget? Where static budgets are prepared for a single planned level of activity. So when we discuss the topic on financial planning and budgeting system, what we are preparing there are actually static budgets, because the master budget all the way to the budgeted financial statements are prepared for a single level of planned activity. Flexible budgets, on the other hand, cover a range of activities. So we might say, what if our sales is at 10,000 units, at 11,000 units, or at 12,000 units? Now, let us put our thinking cap on, and I have a question for you. How much of the favorable cost variance is due to lower activity, and how much is due to good cost control? Well, to answer this, first, what we need to do is to adjust the budget to the actual level of activity. Because if our budget is, let's say, at 12,000 units, we were budgeting to sell 12,000 units and the actual sales is only for 10,000 units, then of course in the actual result, all the variable costs should be lower than the static budget's variable costs, because those static budget variable costs are based on 12,000 units, right? So the first thing we need to do before we compare is to flex the budget, and we will put it at the actual volume of 10,000 units. All right, we'll see this in the next slide. Let us have a look at the advantages of flexible budgets. Well, firstly, it provides the correct basis for comparison between actual and expected costs given the actual activity. Flexible budgets may be prepared for any activity level within the relevant range. It also reveals variances due to good cost control or lack thereof. And finally, it improves performance evaluation. All right, so now let us have a look at how flexible budgets are prepared. First, let us look at the different levels of analysis. Notice right at the top there, if we are only comparing the actual operating income versus the static budget operating income, we are conducting here what we refer to as level 0 analysis. So if our actual operating income is 14,900 and the static budget's operating income was $108,000 and we only achieved 14,900, then we will say that we are short by 93,100. Now that sort of comparison or analysis is not very useful because we do not know what's the reason for not achieving our budgeted operating income. If we go through the line by line, so we have the revenues, we have the variable costs, and we have the contribution margin calculated, and we have the fixed cost. What we are doing now is we are comparing the revenues, the variable costs, the fixed cost for actual results, and the static budget. And that might be a little bit more meaningful, and that's what we refer to as the level 1 analysis. More meaningful because then we can see here that, for example, no wonder our actual sales is only 1,250,000 because we only sold 10,000 units, but we were budgeting to sell 12,000 units, and so we did not achieve our budgeted sales revenue of 1,440,000. Well, what about the variable costs? Direct materials actual cost is 621,600 versus the budgeted 720,000. We might say, well, actually, we saved on direct materials. But is that a meaningful conclusion? Because you have sold less, you are expected to spend less on direct materials, and so with other variable costs. With the fixed cost, well, fixed costs are fixed regardless of the volume. So we have budgeted fixed costs of 276,000, but the actual is $285,000. So again, we have overspent in terms of fixed costs. What would be more meaningful is to have this level 2 analysis, and this is where we will create a middle column between the actual results and the static budget. This middle column is flexible budget. So how do we go about flexing the budget? The first thing that we need to do is to get the actual volume in terms of sales. So even though we have budgeted at 12,000 units, the actual units sold is 10,000. So our flexible budget will be based on 10,000 units at the budgeted price. All right? First, let us calculate what is the budgeted selling price. I've already shown it here actually. So when you divide 1,440,000 by the budgeted volume of 12,000, your budgeted selling price is $120. So your flexible budget for revenue should be that budgeted selling price of 120 times the actual units sold of 10,000. That would give us 1,200,000. That's our flexible budget for sales revenue. All right. Next, we go to line by line, direct materials. What was the budgeted cost for that? Well, 720,000 is the budgeted cost divided by 12,000 units, so that should be $60. So $60 times 10,000 will give you 600,000. That should be the direct materials flexible budget. Let's go next to direct labor. Our static budget was 192,000 divided by 12,000 units, so that should give us $16. Then we'll multiply $16 by the 10,000 units. That would give us 160,000 direct labor cost. Next, we go to variable overhead, 144,000 divided by the budgeted volume of 12,000, so that gives us $12. $12 times the actual volume of 10,000 will give us 120,000. So from here, we can already calculate the total variable cost at the flexible budget. We have 880,000 total variable cost. If we deduct that from the sales revenue flexible budget, we'll get the contribution margin of 320,000. What about fixed cost? Well, remember that fixed costs behave differently from variable cost. Regardless of the volume, you will still expect to spend 276,000 in fixed overhead. So we will just put the fixed overhead there, 276,000. So now, when we deduct the fixed cost from the contribution margin, we'll get the operating income at the flexible budget of $44,000. All right. So now we can do our level 2 analysis. The difference between the flexible budget and the actual results is what we refer to as flexible variances. So notice here, the actual result is 1,250,000 in terms of revenues, but the flexible budget is $1.2 million. And so we have a favorable flexible variance for sales of $50,000. All right. We can do the same for the variable costs. So the difference between the actual result of 621,600 for direct materials and the 600,000 flexible budget is 21,600. So we actually spent more, and therefore that is unfavorable. We'll do the same for direct labor and variable overhead as well as for the fixed cost. So we should really have spent 276,000 only, but the actual is 285,000, and so we have a 9,000 unfavorable fixed cost variance here. So this column here are what we call the flexible variances. Now when you compare the flexible budget column and the static budget column, you will get the sales volume variances. Here, the first is in units. So remember, we were expecting to sell 12,000 units, but we only sold 10,000 units. So we got 2,000 units unfavorable volume. So in terms of the difference between the static budget and the flexible budget, for revenues, we have a difference of 240,000 that is unfavorable because we sold less than what we were budgeting. For the variable costs, you can again compare the flexible budget and the static budget, and the difference, as you can see here, will mostly be favorable because our flexible budget has been adjusted to the actual volume of 10,000 units. But for the fixed cost, you would expect that the sales volume variance for fixed cost will always be zero, because when you flex the budget, the fixed cost will remain the same as in the static budget. So that is what we refer to as level 2 analysis. All right. Now, when you go through these flexible variances, all right, you can still further subdivide this direct material flexible variance of 21,600 unfavorable. You can still subdivide that into two. And what are those two variances? That's the material price variance and the material usage variance. Now, does that sound familiar? Of course it does, because that's what we have been calculating in the previous topic as well as in this particular topic. So the price variances and the efficiency variances is actually a level 3 analysis, and that actually comes from these two columns, the actual results versus the flexible budget. So the 21,600 consists of material price variance as well as the material quantity or material usage variance, and that would be level 3 analysis. It is important to note that flexible budgets are prepared at the end of the period. Now, why is that? Because notice that when we prepare the flexible budgets, we are using the actual volume, and we flex the budget according to the actual volume of units sold. So when would we know what is the actual volume? Only once the period is over, isn't it? So whilst the other budgets are prepared ahead of time as a planning tool, flexible budgets are actually prepared at the end of the period, and this is more used as a controlling and evaluating tool. Having said that, flexible budgets can also be used to plan what would be the costs at different levels of operation. As shown here in DCDesserts.com monthly flexible overhead budget, we are looking at different levels of process hours at 6,000 hours, 7,500, and at 9,000 hours. So you are flexing the budgeted variable cost, but notice for fixed overhead costs, the indirect labor, inspection, production supervisors, and all that are fixed regardless of what level of process hours we are planning to have. We will have exactly the same fixed costs. All right, now we can apply what we have learned for flexible budgeting in this illustrative example. First, let's look at Ultrasonic Company, which is a manufacturer of TV sets. Some of the company's data were missing according to this, and we are asked to use the following information to replace the lost data. So let us fill in the blanks. The first requirement is to calculate the flexible budget revenue. So how do we calculate that? We know that the actual revenues is $42,080, and we have a flexible variance of $1,000 favorable. So therefore, we will have to deduct this 1,000 from 42,080, and we'll get the flexible budget of $41,080. All right, let's go to the next. What is the static budget revenue? This is letter B here. So now that we know the flexible budget is $41,080, and we know that the sales volume variance for revenue is $1,400 unfavorable, so we'll have to add 1,400 to 41,080, and we'll get $42,480. Let's go to letter C. What are the actual variable costs? So we know that the flexible budget is $15,860, and we have unfavorable $200 flexible variance. So we'll get $16,060. Let's go to letter D. What is the total flexible budget variance? We are looking for this figure here. We've got 17,740 and 16,080. $80. So for letter D, we get $1,660, and that is favorable. Now let's go to letter E. What is the total sales volume variance? Well, we know the flexible budget is 16,080 and the static budget is 15,140. So that would give us the sales volume variance of $940, and that is favorable because the flexible budget is greater than the static budget. And finally, what is the total static budget variance? So the total static budget variance is simply the difference between the actual results, operating income, 17,740, and the static budget operating income of 15,140. So the difference is $2,600, and that is favorable because our actual result is greater than the static budget operating income. All right, so that's one way of applying what we have learned in flexible budgeting. Another way is by preparing a flexible budget at different levels of operation. So illustrative example number 2 is about that. Here we are told that the president of Proclaim Limited has asked you to prepare a flexible budget for possible sales and production levels at 10,000, 11,000, and 12,000. And we're provided with the selling price, variable costs for manufacturing, administrative, and selling, as well as the fixed costs. So the flexible budget for Proclaim Limited will be prepared by just multiplying at different level of production and sales the $24 selling price to get the sales revenue. Then we'll just multiply the variable cost for manufacturing is $12 multiplied by 10,000, so you get 120,000. $12 times 11,000, 132,000, and multiply $12 by 12,000, you get 144,000. So you'll do the same for the other two variable costs. Then you'll total up your variable costs and calculate the contribution margin by deducting the total variable cost from the sales revenue. And then we'll just have to put in the fixed costs, 60,000 and 20,000 for manufacturing and administrative expenses. And this would be the same regardless of what's the volume, whether at 10,000, 11,000, or 12,000. So we can see from the flexible budget for various levels that at 10,000, the company will just be breaking even. They will neither make profit nor loss. But at 11,000 level of operation, they will be able to make 8,000 profit, and at 12,000 level, they will be able to double that profit from $8,000 to $16,000. So finally, before we end this lecture, we will revise the calculation of all the material, labor, variable overhead, and fixed overhead variances using this illustrative example number 3, Pradini Leather. They produce quality leather wallets, and they provide us with the standard cost per batch, the actual cost for the month of April, and an extract from the annual budget information, which is useful for calculating fixed overhead. During the month of April, Pradini Leather produced 120 batches of wallets, so that is the actual volume. We are also told that Pradini Leather experienced some operating problems in April. They normally use very high quality hides imported from Italy, but delays caused by dock strikes necessitated the use of significant amounts of cheaper but lower quality Australian leather. Australian leather usually costs 12 to 15% less than Italian leather. We are also told that labor shortages lead to several skilled operators leaving for more attractive jobs. Internal staff are being retrained and will shortly be promoted to replace these people, and new staff have been employed and trained at a lower level to replace staff being promoted. So the requirement is to calculate a full set of manufacturing variances for April for Pradini leather. So we will start with direct material variances. So we'll start with material price variance. The formula you would recall is actual price minus standard price times the actual quantity purchased. Now the actual price is not given, but we can calculate. These are the actual costs for April, and direct material purchase is $50,400, and that pertains to 560 square meters. So we can calculate the actual price by dividing 50,400 by 560 square meters, and that would give us actual price of $90. Then we will deduct the standard price. Now the standard price is given, it's $100 per square meter. Once we've got that, we'll just multiply it by the actual quantity purchased. So here we are told that the direct materials purchased is 560 square meters. So $560 multiplied by the difference between actual price and standard price of $10, that would give us $5,600. And that is favorable because the actual price is lower than the standard price. You know the reason why, right? We are told that the company is currently using lower grade or cheaper leather. That's why they got it at the actual price that is lower than the standard price. Now let's go to material usage variance. The formula is actual quantity used minus the standard quantity times the standard price. So here, the actual quantity used is given at 540 square meters. So even if they bought 560 square meters, we will use the direct materials used, not purchased. So 540. The standard quantity has to be calculated. We know that the actual batches produced is 120. Then we will multiply that by the standard usage, 4 square meters. So 120 times 4 is 480. We'll get the difference between actual quantity used and standard quantity, and then we'll multiply it by the standard price of $100. That is from the standard cost given. So that would give us $6,000, and that is unfavorable because our actual usage is a lot more than our standard quantity allowed. Again, you can see the reason why. Because you are using lower quality material, there will be more wastage compared to when you use the higher grade material. Next, let's go to labor rate and efficiency variances. So labor rate variance is calculated using the formula actual rate minus standard rate times actual hours. Notice the parallel between material price variance and the labor rate variance. That will help you to remember these formulas. So the actual rate is again not given, but we can easily calculate. Direct labor cost actual is 65,100, and that pertains to 7,000 hours. So 65,100 divided by 7,000, that would give us $9.30. Then we'll deduct the standard rate, which is given here. Direct labor standard rate is $10 per hour. We'll multiply that difference by the actual hours of 7,000, which is given here. So 930 minus 10 is 70 cents times 7,000 will give us $4,900, and that is favorable because our actual rate is lower than the standard rate. And again, you can see why, because we are paying these staff that are being skilled up in order for them to replace those people who have left. Let's go to labor efficiency variance. The formula is actual hours minus standard hours times standard rate. So the actual hours is already given 7,000 hours. What is the standard hours? Again, we will multiply the actual production volume, 120, by 50 hours. What is this 50 hours? That's the standard direct labor per batch, 50. So that would give us 6,000. So the difference between actual hours of 7,000 minus the standard hours of 6,000 is 1,000 hours. Then we'll multiply that by the standard rate of $10. So that would give us $10,000, and that is unfavorable because the actual hours is greater than the standard hours allowed. Let's move on now to the variable overhead spending and efficiency variance. So the variable overhead spending variance is similar to your rate variance or price variance. The formula would be the actual rate minus standard rate times actual hours. Does that look familiar? It's exactly the same as your labor rate variance. So what is the actual rate? It's not given, but again, we can calculate quickly. The variable overhead actual cost for April is 80,500, and the actual labor hours is 7,000. So that would give us an actual rate of $11.50. Then we deduct the standard rate. The standard rate is given for variable overhead is $12. So $11.50 minus $12 is 50 cents. And then we'll multiply it by the actual labor hours of 7,000. So that would give us $3,500, and that is favorable. All right, now let's move on to the variable overhead efficiency variance. The formula is actual hours minus standard hours times standard rate. Does that look familiar? Again, yes, it's the same as your labor efficiency variance. So we already know that our actual hours is 7,000. The standard hours is already known because we've calculated it earlier, 6,000. So 1,000 hours difference, multiply it by the standard rate. The standard rate for variable overhead is $12 per hour. So that would give us $12,000, and it's unfavorable. Notice here that whenever your basis of allocating variable overhead is the direct labor hours, whenever you have unfavorable labor efficiency variance, you will also have unfavorable variable overhead efficiency variance. So it's always very much interrelated. All right, now let's move on to the last two variances, the fixed overhead spending and volume variances. So fixed overhead spending variance is very straightforward to calculate. It's just the actual fixed overhead minus the budgeted fixed overhead. The actual fixed overhead is given $66,000. So we'll just put it there, 66,000. What about the budgeted fixed overhead? We can see from the extract from annual budget information that the fixed overhead for the entire year is $720,000. But we are only analyzing here for 1 month, the month of April. So we will divide 720,000 by 12, and that would give us $60,000. So that would be the budgeted fixed overhead for the month. So the difference between actual and budgeted fixed overhead is $6,000, and that is unfavorable because the actual is greater than the budgeted fixed overhead. Next, we'll calculate the fixed overhead volume variance, and this is simply the budgeted fixed overhead minus the applied fixed overhead. So we already know the budgeted fixed overhead is 60,000, but what is the applied fixed overhead? Well, we can calculate. The applied overhead will be equal to the actual volume produced in April, 120 batches, multiply that by 50 hours. That is the standard allowed for fixed overhead, and multiply that by the fixed overhead rate of $9 per hour. So that would give us $54,000. So when we get the difference between budgeted and applied fixed overhead, 60,000 minus 54,000, that would give us $6,000. And again, that is unfavorable because your actual volume is less than your budgeted volume. So if we are going to produce 1,600 batches per year, divide it by 12 months because we're only comparing it to 1 month, then per month the planned activity should be at least 133 or 134 batches. But we only have 120 batches actual for April. Therefore, the actual volume is lower than the budgeted volume. And as a result, we have an unfavorable volume variance. All right, well, this is it for standard costing and flexible budgeting. Let me end this presentation by sharing with you this Bible verse from Lamentations chapter 3, verse 40. It says, "Let us examine our ways and test them, and let us return to the Lord." We have covered quite a lot in these 2 chapters of your textbook, and we have come to the end. But I would still like to share with you one more quote, and it says, "You can accomplish more in 1 hour with God than 1 lifetime without Him." It is really important, if you haven't tried yet, to prioritize God in your life. Perhaps this is the time, especially when we're coming close to the end of the semester and our brain might be overwhelmed a little bit. Try it. Put God first in your life and see what will happen. Let us end with a word of prayer. Gracious Father in heaven, we are so grateful that we have completed chapters 10 and 11. No doubt we have covered quite a lot, but we know, Lord, that we are able to do great things if we put you first in our lives. So we pray, Father, that as we continue on with the rest of the topics to be covered in this semester, that we will learn to trust in you. We ask this in Jesus' name. Amen. All right. Don't forget to do your post-lecture required activities, and I will see you in class shortly. Bye-bye for now.